The US dollar, once an unchallenged titan in the global financial arena, is showing signs of wear and tear. Like a boxer past his prime, its dominance is waning, leaving many to wonder, is this a temporary dip, or the start of a long descent? The answer, my friends, is not as simple as it seems. Yet one thing is certain, the mighty dollar isn't as mighty as it used to be. Understanding why it's faltering and what it means for you is crucial in these turbulent times. For decades, the greenback reigned supreme. It was the world's reserve currency, the bedrock of international trade, the safe haven in times of uncertainty. But the ground beneath its feet is shifting. The dollar's recent slide against other major currencies is a stark reminder that no empire, not even a financial one, lasts forever. Take a look at the numbers, and the narrative becomes clear. The dollar index, a key gauge of the greenback's strength against a basket of major currencies, has tumbled to multi-month lows. The euro, the Japanese yen, even the British pound, they're all flexing their muscles against the once invincible dollar. This isn't just a blip on the radar, it's a sustained decline, fueled by a confluence of factors that have conspired to erode the dollar's dominance. Understanding these factors is key to navigating the choppy waters of the global economy. Remember, a weaker dollar has far-reaching consequences, impacting everything from the price of your morning coffee to the performance of your retirement savings. So, what's driving the dollar's decline? The answer, in a word, is multifaceted. First, the US Federal Reserve's aggressive money printing spree during the pandemic, while necessary to prevent an economic meltdown, has flooded the market with dollars, diminishing their value. Second, the ballooning US national debt, now at eye-watering levels, has made investors jittery. Third, the rise of the BRICS nations, Brazil, Russia, India, China, and South Africa, and their efforts to move away from dollar-denominated trade are chipping away at the greenback's global influence. Finally, there's the looming specter of potential interest rate cuts by the Federal Reserve, a move that could further weaken the dollar. Section 4, the ripple effect on your wallet. Now let's talk about what really matters. You. How does a weaker dollar affect your life? In a nutshell, it translates to higher prices for imported goods from electronics to clothing, travel abroad becomes more expensive, and your hard-earned pounds buy less when converted into dollars. But it's not all doom and gloom. A weaker dollar can be a boon for US exporters, as their goods become more competitive on the global market. It can also benefit US companies with significant overseas earnings, as those earnings translate into more dollars when repatriated. However, for the average consumer, a weaker dollar primarily means tighter budgets and a little less wiggle room. Section 5. Weathering the currency storm. The million-dollar question, or perhaps given the circumstances the shrinking dollar question, is, what can you do to protect yourself? The key is to diversify. Consider investing in assets that tend to perform well when the dollar weakens, such as gold, real estate, or even Bitcoin. Keep a close eye on global currency movements and stay informed about economic trends. Remember, knowledge is power, especially in the ever-changing world of finance. Don't panic, but don't bury your head in the sand either. By being proactive and informed, you can navigate the challenges and opportunities presented by a weakening dollar.